Another rate hike? Is it time for me to sell all of my stock before the bottom falls out? Hi, my name is Dee, and welcome to the Money Growth Academy, where we demystify the stock market, simplify investing, and multiply your opportunities for financial success. And today, we're going to answer the question, is it time for me to sell my stocks? And everybody knows, if you've been watching the financial news lately, the whole big thing has happened, and that is another Fed rate hike. So we're going to talk about what that means, what you can expect. We're going to explore some of that. So it's been all over the news yesterday and today. And let me tell you, people are getting absolutely freaked out. I think the market dropped nearly 2% today. And so, people are just freaking out. So all of this freak out over rate hikes. Well, let's talk about that for a minute. So the Feds have had 4 rate hikes in 2018, and they're expected to have 2 in 2019. Now, the Feds are trying to get to a neutral rate, right? So that neutral rate is where it no longer, a neutral rate is a rate that does not offer additional stimulus to the market to get the market to move. The market's moving just fine. The economy is just moving just fine. So really it's stimulus to get the economy, I said the market, but it's really stimulus to get the economy moving, right? And so that stimulus is no longer needed to get the economy to move. And so with rates, they're trying to manage inflation. They've done a fairly decent job of that, keeping it fairly calm at 2%. And so they're trying to move those rates up. And so it looks like, again, so it was announced, we're going to get somewhere at about 2.8, 2.9 in 2019. But nothing's ever written in stone, right? So just so that you know, in the last meeting that the Feds had, prior to announcing this one even, in their last announcement, they've already walked back 25 basis points increase, right? And so we know they have the ability to adjust if needed as they watch the economy as a whole. So nothing's written in stone. So this is what Chairman Jerome Powell said in his address yesterday. He said, unforeseen events as the year unfolds may buffet the economy and call for more than a slight change from the projections released today. So what they're just saying is, hey, look, we could go up or down just depending on what's happening in the economy. So nothing's set in stone where they're going to raise rates to a certain thing. They may pull those back. Just they're going to watch the economy, how the economy is doing overall. That's what it's about. And so that's something to think about. Another thing to think about is the fact that the economy is softening a little bit. And so that may dictate just how aggressive the Feds move towards a neutral rate position. So, and again, that neutral rate position is very important. And again, it's one of those, a neutral rate is where, again, there's no longer stimulus being added, right, to get the economy to move, because again, it's not needed. And so rates below neutral, it says here, rates below neutral provide an enticement to some companies to load up on debt. So what happens is when you have rates that are below neutral, 0, 1% less, companies will typically take on behaviors that they wouldn't normally do. So they'll do things uncharacteristic of themselves because they just can't help themselves. So whereas companies should maybe reinvest and retool, instead they buy back their own overpriced stock, right, to boost earnings per share, to meet those quarterly reportings. And then they'll also sometimes buy other companies, small and large. So they'll do some M&A, some mergers and acquisitions in order to bolster up that bottom line. So they start to do a lot of interesting behaviors. And some poorly run companies will even borrow money from time to time just to pay dividends, so they can be consistent at paying dividends. When money's cheap, you can do a whole lot of things. But this is one thing that Warren Buffett said that I like. And Warren Buffett says, when the tide goes out, we can see who's swimming naked, right? So what he's saying about that is, see, when the money's cheap and it's low, people do all kinds of things because they can't be seen. right? Very readily. But when the tide goes out, we can see. And what's happening is that tide's going out in the financial market. So we're going to see a lot of naked companies. So we'll see a lot of that. Another, at least a way to think about this neutral rate attainment that the Feds are trying to reach is that when we have the stimulus in the economy that the Fed induced, right, with lower rates, what it does is it artificially inflates asset prices, right? So we have these way out of whack PE ratios, and so the market takes on some characteristics that are not good, and they certainly are not long lasting. And when you continue to have that kind of stimulus in the market, you're eventually going to have a bubble, and that bubble is going to eventually burst. And here's another thought. Alan Greenspan made some comments the other day on, I can't remember if he was on CNBC or he was on CNN, but he made a comment, and it was like a run for cover, right? And I thought that was an interesting comment because, and some people got freaked out about it and got scared, and if Alan Greenspan, hey, the guy, he did what he did. He was an economist, but he wasn't an investor, and so that's what I look at. He didn't make his money from investing in stocks and bonds. That's not what made him wealthy. If he in fact is wealthy, I don't know if he is, but it certainly wasn't done from his investments in the stock market, like maybe a Charlie Munger or Warren Buffett or some of these other guys. So that should give, at least it helped me understand. I didn't get all freaked out just because he said that. And I'm betting there's probably not a lot of economists that hit it big in the stock market. Just my assumption. Economists are really used to dealing with theoretical problems that result from a perfect people taking on perfect behavior and a perfect economy, right? And the real world doesn't look like that. And so, I keep those things in perspective. So when Alan Greenspan, when he starts talking about run for cover, you may want to tamp your brakes a little bit before you think about selling everything just because Alan Greenspan thought it was a good idea. And here's a couple other things you might want to think about is people confuse the economy with the markets, the financial markets. They think they're one and the same, and they're really not. And Larry Swedroe, back in October 2010, in a Money Watch article, he said, the big difference between the market and the economy is that the market is forward-looking and it's unexpected events that primarily drive future stock prices. Thus, it doesn't even matter whether future news is good or bad. What matters is whether it's better or worse than already expected. So let me read that again. The big difference between the market and the economy is that the market is forward-looking and it's unexpected events. It's the unexpected events that primarily drive future stock prices. Hope you understand that. So it doesn't even matter whether the news in the future is good or bad, right? What matters is whether it's better or worse than already expected. And a way to think about this is, again, all that matters is did the company or the market do better or worse than expected? Were people expecting a correction right now? Absolutely. So the economy is, so I'm going to summarize this so you get it, because I really want you to understand this. The economy is what is happening right now. We can feel it, we can see it, it's on the news, right? The stock market is what's happening in the future. And it's how, and if that future aligns to our expectations or not, that's what drives stock prices. So hopefully that helps you. Let's talk about it this way. So typically higher risk correlates to higher return, right? So as an example, we don't put our money as an investor, we don't put our money in a savings account in a bank or credit union. And instead we, as investors, take the money because the rates are low in a savings account right, with the bank or credit union. So we instead take that money and then we put that money into the market, and we put the money into the financial markets with higher degree of risk, with the expectation that we will earn a better return, a higher return. So if we flip that, if we have lower stock prices, I would assume we would expect higher returns coming from the fact that prices are low today. Our expectation in the future that prices will go up and our return increases as well. So it may just be a good time to buy right now. And if you have a buy list, that's what I work with, is I have a buy list of great companies that I want to buy, and I just wait for them to go on sale, right? And so I have my buy list, I check it twice, and then I just wait for the market to come to me, and then I take my winners. The best strategy that for me is, hey, if you own great companies, again, if they're hitting their expectations, I'm not worried. I'm not concerned. Will the price go up? Will it go down? How much further will it go down? I don't know. No one has a crystal ball. This I do know is if I buy great companies and everything about that company is the same today as it was a month ago when it was riding high, then what is it for me to worry about? Because the company's the same, the market's the same, right? So as you think about, should you get out? Should you run? Look, we can't tell you what to do, but we can just give you some thoughts as we did today in terms of if you heard Alan Greenspan say run and take cover, you might want to think about that. Remember why you got into the market and why you bought the stock that you bought, because that will help you make a much better decision than watching all the talking heads on the news channels. So anyway, thanks for checking in with us. We hope that helps you make some better decisions as you think through your portfolio in the coming days. And so we hope you'll take the time, if you haven't already, subscribe. And because I'm telling you, what we do here is all of our work is to demystify the stock market, right? Simplify investing so that you can understand it and you can make better decisions. And by doing that, multiply your options for financial success. We'll catch you next time. Thanks.